So now it's my pleasure to introduce our featured speaker, as you all know. But just as a reminder, make sure you selected speaker view from the top right of your screen. Turn off your video, and then please mute yourself. We did hear a little background there a minute ago. So once Hugh speaks, we'll be able to take questions using the chat feature. So we're pleased again to have Hugh Johnson with us this morning to deliver his State of the Economy during these interesting times. Hugh, as you know, has more than 40 years of investment experience. He serves as Chair and Chief Investment Officer at Hugh Johnson Advisors, a division of JNB Advisors. The firm manages $1.7 billion and serves as a consultant for over $1.2 billion. Hugh is nationally recognized, as we know, for his forecasts on the economy, on interest rates, and the domestic equity markets. He's fortunate enough, he appears regularly on CNBC and PBS news programs, and we've seen him quoted in the Wall Street Journal, the New York Times, NPR, and it goes on and on and on, Hugh. This morning, he will discuss specifics of the economic forecast for both the U.S. nationally and for New York State, as well as the outlook for interest rates and stock prices and other important issues. So whatever the future may hold, Hugh's expert insights will impact how you run your business, how you manage your investment portfolio, and how you should save for the future. So great honor for me, a pleasure to welcome and turn the screen over to Hugh Johnson. Hugh?
Thanks, Paul. Thank you very much. Hopefully everybody can either see me or hear me. And once again, even though it's under trying and different circumstances, circumstances which are sort of captured or summarized in my first slide, which is a cartoon. But things are different this year. But even though they're very different this year, as we all get together virtually, I'm going to try to preserve some of the traditions which we've had for so many years. We've had a couple of traditions. One tradition, of course, is, as you remember, ordinarily when we get together, I tell you a story. Some people refer to it as a joke, and then I go on to give a forecast. And as we now know so well, it's unfortunately sometimes difficult to tell which is the joke and which is the forecast. But nevertheless, we're going to try to hold to that tradition. This year, what I'm going to do is I'm going to dedicate the so-called joke or story, a real story, to a woman who works with me, and Dan Nolan. Dan, of course, is the Chief Executive Officer of our company, and Candace Wyan, who may be, we don't know for sure, maybe, let's call it hanging up her spikes this year. And so I asked Candace the other day, I said, of all the stories we've heard, we've shared, we've talked about, which is the one that you like the best? And here's the one she likes the best. I'd like to call it a true story. I was in New York City one day, and I opened the New York Post. I saw an order. I saw an ad placed in the paper by some guy from Peekskill. It said he had a talking dog for sale for $500. I said, well, that's interesting. After all, I do like dogs. So I called him up he invited me to come up to his house and meet the dog. I went to his house and told him I was here to see the dog, the talking dog. And he said, okay, come in. He said, you can find the dog. He's in the living room, curled up in the corner. So I walked in, saw the dog, and I asked the dog, are you the dog that talks? The dog looked up at me and said, yes, that's me. What do you want? Well, I'm here to buy you. Tell me about yourself. Well, I not only talk, but I'm a real hero. You're a hero? Tell me about it. Well, once upon a time, I saved a man's life. It was in the winter, and he walked out on the pond down behind our house. The ice broke, and he fell in. I ran down, edged out to where he was, and pulled him to safety. It was quite a feat. The town honored me. I went to the town hall where the mayor gave me the Peekskill Good Citizens Award. But that's not all. Remember when there was a train wreck along the Hudson about a few years ago? When the wreck occurred, Governor Cuomo called me and asked me to help the rescue. I went down to the wreck, climbed into the train and pulled out, rescued 16 people. The governor called me up to Albany where he gave me a special Hero of the State Award. Okay, there's more. Remember 9/11? Well, President Bush called me and asked me to help out. I went to New York City and went into the building, pulled out 4 cops and 5 firemen. The president asked me to come to the White House, where he gave me the Medal of Honor. Wow, that's quite a story, I said. I left the room and went out to the owner, and I looked at him and I asked him, why would you ever want to sell this dog? He looked at me, he said, well, he said, I wouldn't, except he's a freaking liar. I don't hear any laughter, which is a problem with a virtuous relationship, but nevertheless, that's the story. One other sort of tradition that we've had is, of course, which has been almost an embarrassment to me. I've tried to avoid it every year. And when my grandboys, my grandsons, twin grandsons, with the names Huey and Stewie, were born, and everybody's sort of insisted I bring you up to date on how they're doing every year. Now, this is not a recent picture. This is obviously an old-time picture where they were standing by the door looking for me to come, hoping that I was going to bring them loads of toys, which invariably, given the pressure, I always did. And here's their picture today. It's hard to believe they're twins, but here it is. And of course, then Mom says if we wear these jackets and act chummy, Grandpa might kick in for college. But anyway, the boys, to bring you up to date, sorry to have to do this to you every year, but nevertheless, here it is. They're doing great, and they're not going to college yet, so I've got a couple more years of breathing room. And then another tradition we've had is we've had a report card. We've had to look back and review some of the forecasts that I made the prior year and to see how we've done. This, as my good friend Roberta says to me, she says, remember, Hugh, it's always, if you give a date, don't give a number. And if you give a number, don't give a date. Well, I make that mistake every year. I give you both a number and a date. And so we're going to take a quick review just to be true to our tradition. But it's not something I'd be particularly overwhelmingly proud about. But nevertheless, we want to stick with the tradition, and I want to make sure that I bring you up to date on how we're doing. This was a really, really difficult year. As you remember, when we talked last year, I said that of the 32 years that I've been talking to you, there's never been a time when I was more concerned about prospects for the economy and the financial markets. When I concluded some of my remarks, you might remember that I said that it was not raining when Noah began to build the ark. And then I asked the question, it wasn't raining that day, I asked the question, do you think this was December of last year, should start to build an ark? The reason I, of course, said that was in my judgment, the evidence was pretty overwhelming that we were pretty close to the end of the cycle, a cycle which, of course, consists of 3 parts: a stock market cycle it's accompanied by, followed by an economic cycle, which is ordinarily accompanied by or followed by an interest rate cycle. I was fairly convinced we were pretty close to the end of that. And the reason for that, of course, is that at that point in time when we got together last year, this had been the longest cycle in our history, going back to 1890. Secondly, the yield curve, it's a little technical, but the yield curve had inverted, and the inverted yield curve told us pretty clearly that the probability of a recession starting in the next 12 months was very high. And then thirdly, the index of leading economic indicators, which I do spend time on, had declined for 3 months in a row, 7 of 9 months, and was also telling us fairly clearly that the probability of a recession starting in the next 12 months was very high. So as far as I could see, based on those, some of those indicators, it appeared to me that the end of the cycle, a recession was certainly in the cards. For some reason or other, I decided to back away from that dire a forecast, and I gave a forecast, and the forecast is summarized on the next 2 pages, this slide and then the next slide. And as you can see, my expectation generally was that the economy would slow, but it would not turn down. It would not contract. I thought that gross domestic product, which is our scoreboard for the economy, would be a slower growth in the economy, and 2020, but it certainly wouldn't contract or turn down. I thought that we would continue to expand as far as adding jobs to payrolls, but I didn't think we'd add as many jobs to payrolls as we did in 2019. And we could go down through this. The expectation generally was that the economy was going to slow but not turn down. Inflation might be a little bit higher. And in response to a little bit higher inflation, the federal funds rate, which is a measure of Federal Reserve policy, would rise some as the Federal Reserve responded to modestly higher inflation. And then, of course, in response to what the Federal Reserve did, short-term interest rates as measured by 2-year treasuries would go up a little, 10-year treasuries would also go up. And then the stock market, in response to a better economy, a little bit better economy, slower but better, would also go up. Well, as you can see from these numbers, we got just about everything wrong. It really dramatizes how difficult, in my judgment, it is to try to forecast. Forecasting is very difficult under the best of circumstances, but certainly when you're trying to forecast when you're at turning points, we'll call them inflection points in the markets or the economy. For those of you that are technically inclined, when you start to move from concave up to concave down, it gets very difficult. And then when you superimpose on a very difficult turning point in the economy, a so-called, we'll call it a black swan event, an exogenous event, an unexpected, a big surprise, such as coronavirus, then it makes it even more difficult. So the bottom line is, here's our report card for what our forecast for last year. Not particularly good, but I think in some ways pretty understandable. Nevertheless, we'll keep moving on. Let's see what lies ahead for this year. The one thing that jumps out at you when you take a look at the forecast for last year is that the economy did a lot worse than anybody, myself certainly, but anybody had really expected. But the one thing that also jumps out at you is that even though the economy did poorly, the stock market went up. This was mentioned before by Paul and how do we and Tom, and how do we possibly explain it? The one question I get, and I continue to get, is how do you reconcile the performance of the stock market or the financial markets in general, quite frankly, with the performance of the economy, with what's going on in this world of ours, with the significant problems that we have with the pandemic, et cetera. And this is even before we started to really think or take seriously the strong possibility that a vaccine would start to be introduced and maybe make a big difference for the economy, a return to normalcy. So there was a big question, how do you reconcile those two? And to try to answer those, we go back to the sort of our basic methodology and see how we can do it. The methodology, which I'm going to follow now, and I'm going to try to go through this as briefly or as quickly as possible, but it's important. And that's really to, first of all, identify the important trends that are unfolding in the financial markets. What's the message of investors collectively in the performance of the financial markets? And then the second thing is to identify important trends in the most important monetary variables and economic variables. And the whole purpose of that step is to try to determine if indeed the trends in the financial markets, the message from investors collectively, are rational. Are they consistent with a rational forecast for what lies ahead for the economy and earnings, inflation and interest rates? Are they consistent with the performance of monetary variables, as they sometimes tell us about Federal Reserve stimulus or restraint, stimulus or restraint, and are they how do they fit with the important economic variables, some of which tell us about fiscal policy? Is fiscal policy, is it fiscal policy stimulatory? Is it a stimulus, or is it a restraining? So the question is, what are the performance of the financial markets telling us? And what are they consistent with important monetary and economic variables? Are they justified? And that's what we've got to really try to determine to reconcile the performance of the markets with economic variables. Once you've done this, of course, as I've mentioned so often in the past, we're really not done. It's important to start to move on to recognize that markets, when they are like today, if they're rational, they sometimes move on and become a little bit less than rational. I've talked about manias occur from time to time in our financial market history. In this current financial market cycle, there's a real chance that we could have a mania in this cycle. That's one of the big questions that I get asked. As you know, in a mania, we move from something that's rational to a little bit less than rational. We move from a period of optimism when investors move from the so-called investment stage to the stage of speculation to maybe exuberance and even on to euphoria. Investors move from investing sensibly to borrowing money to buy assets at prices that are arguably too high, with the hope and the dream and the fantasy that they're going to go even higher. As Kindleberger, who I talk about a lot, reminds us the advice of a banker, a very conservative banker during the South Sea bubble. In a mania, when the rest of the world are mad, we should imitate them in some small measure, and generally people do. And we enter into what I've called a monkey see, monkey do type of financial market environment. That kind of a market environment, that market of speculation gives way to a financial distress. In financial distress, of course, prices stop going up, and the speculators, investors who have become speculators have trouble making their debt service payments. Some do not. And default, the lenders who finance the speculation begin to get cold feet, back away, and prices start to decline. That's when we go from a period of speculation to a period of financial distress. And as Kindleberger also reminds us, that the speculative episode always ends not with a whimper, but with a bang. So we need to know if we've moved from the stage of investment to the stage of speculation to a mania. I'm asked the question, are we there now? Has the current financial market environment, the equity market environment, become somewhat of a mania where we have to be on our toes? And my answer to that question is no. We have not moved into the period of speculation. There are three defining characteristics of a period of speculation. One, of course, is overvaluation. We might be able to make the case that we have a valuation problem. I'll get to that a little bit later. Valuation is a problem. The second thing is leverage. As I mentioned, investors borrow money to buy assets at prices that are arguably overvalued. Leverage is a defining characteristic of a period of speculation, or one of three. And then the third, of course, is the level of optimism. Optimism which gives way to exuberance, which finally gives way to euphoria. We have objective ways of measuring the level of optimism or euphoria, exuberance or euphoria, and using those, looking at those metrics. I would say that the one thing that's missing, and has been missing from this stock market rise, has been the level of optimism. Optimism continues to be surprisingly low. And I might add that although we can make the case for a little bit of higher valuation, we don't see the level of leverage or borrowing by individual investors to finance speculation that we ordinarily see in a mania. So my conclusion is, at least today, and this needs to be followed very carefully, is that we are not as yet in a mania, and that's pretty important. And now the question is, of course, let's take a look at what the performance of the financial markets has been, and is the performance of the financial markets that we've seen since March, when the market turned, is it justified? Can you reconcile the performance of the financial markets with what's going on in this world of ours? If we look at the performance of the financial markets, I would say not only is it the case that when I look at the performance of the financial markets overall, is it positive, but it's stunningly positive. And when I say that stunningly positive, I would say, I don't like the expression, but I'd say this is almost picture perfect for the beginning of a bull market. First of all, of course, the Standard & Poor's 500, the measure of the stock market, is up since the market turned on March 23rd, is up 57.9%. So the principal trend in the stock market is clearly positive. It's also the case that investors have done exactly what they do at the beginning of every bull market. They've migrated to the so-called bullish sectors of the stock market. They're the best performers. That includes all of the so-called economically sensitive sectors, You see the list on this, this slide. I hope you're seeing these slides. And if you are seeing these slides, you can see that the top really 5 performing sectors are all the so-called economically sensitive sectors, or sectors of the stock market and the economy and the stock market that generally performed well when prospects, or how the outlook for the economy starts to get brighter. The outlook for the economy and earnings starts to get better. And of course, the ones that don't need really a positive outcome for the economy, that will perform well under any economic conditions, are at the bottom of the list. Healthcare, real estate, utilities, staples. They're very dependable. They perform well. They're at the top of the list in a bear market, in a declining market environment, but they're at the bottom of the list in a bull market, and that's precisely where they are now. In addition, we see that small and mid-cap stocks are outperforming large-cap stocks. Large-cap stocks are perceived to be very safe. Mid and small, much more, shall we say, much more risky. They carry what we call higher betas. They're more risky, but it's also the case that when you're at the beginning of a bull market, the mid-cap and small-cap stocks start to outperform the large-cap stocks, because that's where the prospects for significant gains in earnings are the highest. Small-cap stocks have just more recently sprung to the lead, or sprung up to the top of the ladder, and they've done so largely because of the outcome of the election, where it started to become somewhat obvious. It's not true at all yet, but that the Senate would be maintained or in the control of the Republicans and investors. This does not at all reflect my personal bias, but investors collectively believe that if the Senate the Republicans keep control of the Senate, it'll be more difficult for Biden to pass his tax increase proposals as a part of his long-term plan. Let me just say one thing that's important. It is true that there are tax increases that are an important part of Biden's longer-term plan, but keep in mind that those tax increases are offset or neutralized by significant increases in government spending on infrastructure, on the environment, and on healthcare, and that therefore the bottom line of his proposals or package is really, we'll call it fiscally neutral, not negative, as investors may have concluded. But nevertheless, small cap stocks are starting to perform well, which is exactly what they ordinarily do at the beginning of a bull market. It's also been the case that growth stocks outperform value stocks. But believe me, I don't think you can learn much from this, because growth and value perform about the same over long periods of time, although value tends to perform better at the beginning stages of a new bull market. And value stocks are now starting to perform better. In addition, there are many other facets, aspects of financial market behavior, which I have to look at as very positive. This chart, you can see very clearly that quality spreads, the spread between, or the difference between the yield on a BAA corporate bond and a 10-year U.S. Treasury note has narrowed significantly from 419 basis points, or 4.19%, to 2.35%. That means investors are becoming much more optimistic about prospects for the economy, and therefore that any corporation where they buy a corporate bond is not going to get into trouble because of economic conditions. The same is true of even of junk bonds. The so-called quality spread there is also narrowed significantly from 989 basis points when we started the bull market. It's now down, this is hard to believe, but it's down from 989 to 336. So quality spreads in the credit market sending a very clear signal that prospects are good for the economy. And then there's our favorite one, the yield curve. As we move through 2020, we've seen the yield curve steepen some. And the yield curve is sending us a message. And I've told you in the past that this can tell us, that gives us the probability. The yield curve today gives us the probability of a recession starting in 12 months. And as we move through 2020, it gave us a steeper yield curve, and the steeper yield curve told us that the probability of a recession starting in 12 months, which really means November 2020 up to October of 2021, is going to get less and less and less. It's pretty high, and this is important, it's pretty high at the beginning. You see February 21, where the percentage or probability is 30.7%, but nevertheless it comes down. In other words, the yield curve is steepening, and that also is an indication that investors are becoming more optimistic about prospects for the economy. So the point being is this is almost picture perfect. I don't think I've ever seen a time when the performance of the financial markets has been more clear. And it's clear, and it's saying that prospects for the economy, importantly, and earnings, and I might add inflation and interest rates is very positive looking forward. And the question is, this is the performance of the financial markets, is it justified? It's hard for me to overstate this part as well. It's very justified. And it's very justified on the amount of stimulus that we've seen and the amount of stimulus we're likely to see in the future from both the Federal Reserve as well as the federal government in Washington in the form of fiscal stimulus. First of all, the Federal Reserve, they immediately, when the pandemic broke, reduced short-term interest rates of the federal funds rate, their target for the federal funds rate from 1.5 to 1.75%, down to 0 to 25 basis points. They did that by adding approximately $2 trillion in excess reserves to the banking system, which gives the banking system increased ability to support an increase in lending and an increase in money growth. As a result, we've seen predictably a significant increase in bank lending. Bank lending is measured by the growth rate of commercial and industrial loans growing at an average annual rate of 25%. The long-term average of the growth rate of commercial and industrial lending is about 7%. We got 25%. Money growth, that led invariably to increase in the growth rate of the money supply. Money supply growing now at 16% annual rate. The long-term average growth rate of money is about 6%. And the combination of an increase in bank lending and money growth has led to positive domestic liquidity conditions. There is enough money in the U.S. economy to drive both the economy and the financial markets, and I might add, and then some. Liquidity conditions are now double the highest level they've been since 1960. So keep in mind that when liquidity conditions are positive, the stock market on average has gone up 13.2%, and when liquidity conditions are negative, the stock market has not performed as well. It's gone up only 2.2%. Liquidity conditions matter. Liquidity conditions are now very positive. So the message of the financial markets collectively is that we have further to go, that prospects are good for the economy, earnings, inflation, and interest rates. The question is that justified? And on the basis of looking at Federal Reserve policy, the stimulus of Federal Reserve policy, and looking at fiscal policy as well, the answer is probably yes. Fiscal policy. What is the federal government doing? The level of spending is now $6.6 trillion in 2020 versus $4.5 trillion in 2019. The deficit has increased, and this is for 2020, to $3.3 trillion. Think about these numbers. $3.3 trillion from $984 billion. That's triple. The level of the deficit has gone now from being 16% of gross product up gone from 4.6% up to 16%. We have not seen a deficit that's that high as a percentage of the economy. We have not seen anything that high since 1946. So investors essentially have got it right. They forecast that the economy and earnings would do well. And indeed, that's precisely what has happened after a very significant decline in the economy contraction in the second quarter of 33%. That little bit overstates it, that number. But nevertheless, over 30% contraction in the economy in the second quarter. Indeed, the economy has turned positive, plus 33% in the third quarter. And I would expect something in the order of plus 3.7 in the fourth. And the same thing's true of earnings. Earnings will expand in the third quarter versus the second quarter, and expand in the fourth quarter as well versus the second quarter. So investors bet, or shall we say predicted, forecast, sent a message that the economy would do well, earnings would do well, and indeed that's precisely what's happening, precisely what's going on. But it's more than that. It's not just that the index of coincident indicators, which tells us how the economy is doing well. It's also the index of leading economic indicators, very important. Indicators that tell us where the economy is going, not where the economy has been. And they also have turned very positive. They've been up 6 successive months and are telling us that not only will the improvement or the growth of the economy that we've seen in the third quarter and the fourth and the growth of earnings in the third and fourth quarter will continue through the 2021 and 2022. I've got some numbers at the bottom of the page there, which tell you the consensus forecast, our forecast, as well as the consensus forecast, or close to the consensus forecast for the economy and earnings as we move through 2021 and 2022. The first number is wrong. It's just 4.3 in 2021, and 2022 is 2.8, and earnings 2021, 22.5, and 2022, 9.2. The point being, earnings are going to contract for all of, the economy and earnings are going to contract for all of 2020, even though they're going to be improving or getting better in the third quarter and the fourth quarter, and are likely to continue to get better through 2021 and 2022, whether we're talking about the economy as measured by GDP or earnings. So once again, it's not just where we've been. It's not just that things are getting better now. It's that they're likely to continue to get better through 2021 and 22, especially the earnings numbers. If you ask the question, why are investors so optimistic? They're optimistic because whereas the earnings declined 16% in 2020, they're going to rebound or grow at the 22.5% rate in 2021. That's pretty darn encouraging. Here's some specifics on the forecast, and as you can see, here's a forecast for the U.S. economy, and I think this is about right, and I think the one measure you see here is that the economy is going to continue to expand. But if we look at it for the year, that's 4.3 or 2.8%. It's going to continue to expand as we move through 2021 and 2022, although the quarterly growth rates annualized are going to be positive, but they're going to continuously come down. I got two things that needed to be mentioned with regard to what we're going to see for the economy. The first is, yes, it's the case, as I mentioned, for the third and the fourth quarter, things are getting certainly better. The economy is expanding for the third quarter and the fourth quarter. But I think it's also important that if you take a very close look, you will see that things are slowing down as we move through the fourth quarter. They're positive, but they're slowing down. And you see that, for example, in the employment numbers. You'll see that in the employment numbers when you look at them this Friday. They're coming down, and they're coming down from, again, 2.725, 2,725,000 added to payrolls in the month of May. June was 4,781,000, but they come down each month. They come down each month, showing that we're adding to payrolls, but we're not adding at the pace that we did back in June. The recovery is continuing, but the recovery is losing pace. And you see that also in savings. Individuals have had very high levels of savings, over 30% in April. But those savings rates are coming down. They're dissipating their savings and using their savings to support their spending. Remember, there are still 5.3 million people that do not have jobs, more unemployed today than there were at the beginning of this pandemic at the end of 2019. So there's a lot of unemployed. They're using their savings, they're dissipating their savings, and also you see that consumer spending is also declining. In other words, there's a lot of individuals out there that are still unemployed and that are hurting, and that's why we need, so importantly, we need stimulus right now out of Washington to try to make sure that we get through the fourth quarter, but most importantly, the first quarter. Remember, I showed you the yield curve, and I showed you that the probability of a recession starting in the first quarter of next year. I'm not forecasting that. I still think the first quarter is going to be positive, but the probability of a recession starting in the first quarter in February was 30% plus. And it's 30% plus largely in part as a reflection of the fact that things are slowing down right now. And the chances that we're going to have to revise downward some, not a lot, our forecast for the first quarter of 2021 is probably pretty good. That's the bad news. Here's the good news. The good news is, what does the vaccine imply for the economy? And this is not looking at the first quarter, not the fourth quarter of the first quarter. This is looking beyond the first quarter. And if you look beyond the first quarter, this is a summary from Capital Economics. Capital Economics works very closely with JNB, Hugh Johnson Advisors, and they're very good. They have 70 economists located throughout the world, and they provide us ongoing very good and very insightful insight into what's going on in this world of ours. Most importantly, though, we're talking about an increase in world growth rate forecast, an increase of 0.8% for 2021, and an increase of 0.5% for 2022. What that translates into, at the bottom of the slide, you can see the US, we've got it at 4.3% for 2021. It comes up to about 4.8% for 2021. That's the impact of the vaccine, a very positive impact of the return to normalcy. And for 2022, 2.8% goes up to 3.5%. So the vaccine, while the economy is slowing, while we really need stimulus to get us through the first quarter, the positive news is when we get to the second quarter and the third quarter and beyond, depending on how widespread the distribution of the vaccine is, it's likely to have a significant impact on the results for the US economy as well as earnings, and that's really positive. The next thing, of course, is let's take a look at other specific numbers. Employment. Again, we've got employment is going to continue to grow or expand on average every quarter through 2022. But again, just as the growth rate of the economy is going to slow as we go through 2021, 2022, it's also the case that the average number of jobs that we add to payrolls each quarter as we move through 2021, 2022 is likely to slow. Keep in mind, and the unemployment rate will continue to come down to, we're not going to get back to the level of output as measured by GDP until about the third quarter of 2021, the level of output that prevailed at the end of 2019. And we're not going to get back to the level of employment that prevailed at the end of 2019 until we get into 2023. But both are headed in the right direction. We simply won't get back to those levels that prevailed again at the end before the pandemic. This is the unemployment rate. As you know, I've talked a lot about the fact that, look, it's going to be hard to get this economy really going to recover. And it's going to be hard for reasons that go well beyond this particular pandemic. The population is clearly slowing. The participation rate is low. That is the percentage of the population that are actually working in the labor force or actively looking for jobs, either employed or actively looking for jobs, is coming down. And the productivity of those that are in the labor force is also coming down. So the output per person is coming down. It's going to be hard to get a lot of growth in an economy which has those fundamentals facing it. But nevertheless, and that's probably one of the reasons why the shift in the economy to being much more of a knowledge-driven economy than a labor-driven economy is really quite a good thing. In other words, a thing that really, in my judgment, is positive. There's a lot of things we could talk about on this slide. I wanted to take some time to show you some of the things that are going on and compare them to what went on in the agricultural business back in the early 20th century. And then I think I'm pretty optimistic when I say, although it's the case that we are certainly having a shift in the economy from a manufacturing-driven economy to a knowledge-driven economy, and that spells jobs. There are lots of new jobs that are starting to be created by new businesses. The fastest growing occupations you've never even heard of 10 years ago: wind turbine service technicians, solar voltaic installers, information security data scientists. These are the kinds of things that are being created and will likely offset the loss of jobs in the manufacturing sector. We could talk about this for a very long time, a fundamental shift in the economy, and we probably don't have enough time for it right now. Okay, let me move on. Consumer prices. One of the worries is, of course, that not only will the economy continue to expand through 2021 and 2022, but also that because of the growth in the money supply, and again, unprecedented growth in the money supply, justified but unprecedented, we're likely to see higher inflation. That, I might add, importantly, is not in the cards for 2021 and 2022. It's not in the cards for two reasons. First of all, the velocity of money is not very high. In other words, money is not that active in the economy. The economy is growing slowly. But the point is that money is not creating the upward pressure on prices that it would ordinarily cause if the velocity was much higher. But importantly, and this is the important point, is that if we did start to see higher reports, higher numbers for the level of inflation, the Federal Reserve could do something about it. I'm going to give you something just a touch technical. I'm just going to say it, and maybe we can get back to it in the Q&A, and that's this, is that the Federal Reserve could do something about it. And what they could do about it is increase, stay with me on this, increase the interest that they pay on excess reserves. If they increase the interest rate they pay on excess reserves, that reduces, to some extent, the incentive of banks to use those excessive reserves to support a higher level of bank lending and a higher level of money growth. In other words, yes, you have high money growth, and yes, it might lead to upward pressure on prices, but it's not as though the Federal Reserve doesn't have anything they can do about it. There is something they can do about it, and they will. Now, they have committed themselves. They have said that as long as we don't get too far above the 2% target, they're willing to tolerate above target for some time, some period of time, which implies, in my judgment, implies very clearly that the Federal Reserve is not likely to change interest rates anytime soon. That's a little complex, and maybe we get to it in the Q&A session. Let me go to some specific forecasts for interest rates and stock prices. And first of all, interest rates, as I just mentioned, even though the inflation rate might get to 2% in 2021 and 2022, and maybe even a little bit above, the Federal Reserve is fairly committed to keeping interest rates low, 0 to 25 basis points, right through 2021 and 2022, in my judgment. In response, I'm giving you the forecast, the consensus forecast for short-term interest rates. The consensus forecast is assembled by Bloomberg, and also my forecast. And you will see that the consensus forecast has short-term interest rates gradually rising, even though the Federal Reserve is holding interest rates unchanged. And I have short-term interest rates essentially, when you get to 2021 and 2022, remaining very little change. There is a difference between the consensus forecast and my forecast. I don't know what to tell you except to say that I would certainly take the consensus forecast very seriously. They're very good. Here's the forecast by the consensus as well as myself on a 10-year Treasury, longer-term interest rates, and you see the same phenomena. You see, even though the Federal Reserve is going to leave short-term interest rates unchanged, I have longer-term interest rates I have as being fairly stable through the forecast period of 2021 and 2022. And the consensus has longer-term interest rates as measured by the yield on a 10-year Treasury gradually moving higher. There's a difference between the consensus and myself on Federal Reserve on short-term interest rates as measured by the yield on a 2-year and also on the yield on a 10-year. Stock prices. What I've done is I've tried to give you an idea of what I think if we use the consensus forecast for interest rates and what would happen if we use my forecast for short-term interest rates. If we use my forecast for short-term interest rates, which of course I encourage, we have the S&P being a little bit pricey now, a little bit too far, too fast, a little bit pricey, being 7.6% overvalued with an upside potential between now and the end of 2021 of 10%. Not bad. If we use the somewhat higher level of interest rates forecast by the consensus, we're a little bit more overvalued, 8.8% overvalued now, and the upside potential is 4%. The bottom line is, I think we're a little bit pricey. We got to become very far, very fast. We're a little bit, doing these numbers is very tough, folks. But nevertheless, I've got us a little bit pricey, a little bit overvalued, regardless if we use the consensus forecast or my forecast. And that the upside potential is positive, but not overwhelmingly appetizing. Let me say something important, and that is if you compare the return on fixed income securities with S&P 500, you know, it's going to be hard given the level of interest rates and the commitment of the Federal Reserve to keeping interest rates low. It's going to be hard to make money in the fixed income markets. You can do it, but it's going to be very, very hard to do it. It's not going to be hard, even though those returns that I mentioned before are somewhat on the low side. are somewhat on the unappetizing side for equities, look, it's about the only game in town. So part of the reason, part of what will be driving stock prices is the fact that it's, I don't like to say it, but it's the only game in town that the returns are going to be, even though they're going to be somewhat low, I don't think they're that low, but somewhat low and somewhat unattractive, there's certainly going to be what's available from the fixed income markets. And that's why it's important for investors to continue to overweight equities in their balanced portfolios. I've got a whole slug of slides on the New England economy. I'm not gonna wade through these slides. I'm just gonna tell you I've done the work. I want you all to understand that you can get these slides from Debbie, and it's important because I've done something different this year. And what I've done something different this year is I've taken both the state, I've taken metropolitan statistical areas, and I've taken counties. And I've asked myself the question, how many jobs, real jobs, have they lost in 2020? What's going to be the outcome for 2020? And to what extent are they going to make back those jobs in 2021 and 2022? So looking at the slide that you see here, I had last year said that I thought New York would be the best performing economy as measured by employment in 2020. It was not. It was the fifth best. And as a result, it was the fifth best, or it was down the line because such a high percentage of New York's gross state product or economy is confined to or is in the leisure and hospitality and accommodation business, much more than other states. And the leisure, hospitality, and accommodation part of the U.S. economy, of the New York economy, contracted, hard to believe, 60% in 2020. So it didn't come out number one, it came out number 5. But I think it will return to being number 1 in 2021 and 2022 on the percentage increase in employment. And the charts that I'm going to show you are going to show you the number of jobs that are lost in 2020 and the number of jobs that are regained or recovered in 2021 and 2022. And you can see for New York State, losing 930,000 jobs, regaining 700,000. I'm going to go on. I want you to get those charts and I want you to look at it. And I'm going to just summarize because I'm getting the high sign from my friend Candace here saying that I better try to wrap it up. Let me give you the bottom line. Last year I felt really bad, and I felt bad because I felt that we had come close to the end of the cycle because this was the longest cycle in history. The yield curve had inverted. Leading indicators for the economy were declining. This year, the story is different. This year, the story is, look, this is the shortest cycle in history. We have further to go. We've had only 6 to 7 months now of this cycle. The average cycle in the post-war period is 63 months. So this is a short cycle. It's a different story. The yield curve is no longer inverted. As I mentioned, the yield curve is steepening and telling us that the probability of a positive outcome for the economy as we get past the first quarter of 2021 is getting better and better and better with each day. It's not getting, as it did last year when we got together, worse and worse and worse. And finally, whereas last year the leading indicators of the economy had declined for 3 months in a row and 7 out of 9 months, this year they've increased or improved for the last 6 months, and it's probably going to be 7 months when we see the November numbers. The things are very different this year. I'm extremely optimistic when I take a look at the configuration of events, of financial market events and fiscal and monetary events that we're looking at this year. But I also want to raise one other issue, and this is an important issue. I look at the configuration of events that we're currently facing, and we're facing, in some ways, the end of a war, the end of a pandemic, low and declining short-term interest rates, big federal budget deficits, and they're going to be big, the end of a bear market and the start of a bull market, the end of a recession and the start of an expansion. That's a pretty positive configuration. And let me tell you why I think it's such a positive configuration, because being a student of financial market history, I asked myself, what does this compare to? And you got it. It compares to 1919 and 1920. And as you know, 1919 and 1920 were followed by the 20s. And needless to say, the 20s were a positive environment for not only the U.S. economy, not only U.S. social life, but just for life in general. I think we're headed towards, quite frankly, an extremely positive period of time, which is going to be good for savers or investors, and also good for all of us in this economy. I think we're headed towards, I don't want to call it the gay 20s or whatever the expression might be, but I think a very, very positive environment. Let me just finish by saying, giving you something that I shared with you maybe 8 years ago, 10 years ago. It's a rhyme which I saw over a bar in Ireland, and I've loved it, and I've loved it ever since. And I'll finish this year's session with this. And it goes, whether the weather be fine or whether the weather be not, whether the weather be cold or whether the weather be hot, we'll weather the weather, whatever the weather, whether we like it or not. As I look to next year, as I look to the next 10 years, I'm very optimistic. I often sing a song, I won't sing a song, but if I were to sing a song, it would be blue skies, nothing but blue skies. Thanks very much.
So thank you, Hugh. With everything going on, it's wonderful to hear your thoughts and some positive outlook of coming out of this pandemic. So we can't thank you enough for your time and your comments here. So thank you. Let me try to facilitate some Q&A here that's come in through the chat room. I'm going to start out with one that came up, maybe more of a capital region centric one, Hugh. Yeah. A lot of businesses, probably some of the small businesses, but middle and large as well, have seen 60, 70, 80% loss in revenue. They're hanging on. Obviously, some have closed. You spoke to it a little bit. Maybe you can expand. What's your best forecast when you think they're going to come back to their old revenue numbers, for the pre-pandemic? Yeah.
Here's a table. I'm putting it up on the, and hopefully you can see it. And the capital region, metropolitan statistical area, will have lost at the end of this year when all said and done, 35,000 jobs. In my judgment, we're going to regain 17,000 in 2021 and 11,000 in 2022. Statistics can be off, but I'd be willing to bet, I'll bet I'm close, which means of the 35,000 jobs, will we regain 29,000? That only happens when you have an economy which is recovering. And my expectation is that for those that are patient, the economy will be recovering. But I understand that that's easier said than done. When I've talked to people at Pursuit, such as Tom, Pat McCrell, and others, there's probably going to be some of these businesses that are hanging on, and some will make it and some will not. But I think I would leave you, and I'm not saying this to be Pollyannish, I would leave you very definitely with one positive understanding. The U.S. economy is going to be recovering, continue to recover, and that's important, through 2021 and 2022. And the financial markets are telling you that clearly, and the important monetary and economic variables are telling you that also very clearly. Never before have I seen such lopsided numbers. And that's to me important. If I were to place probabilities, I would say the probability is hang on, we will be recovering, and that'll be particularly true if the vaccine works and we start to see a return to normalcy in Q2.
And somewhat related, Hugh, there was a question here about the labor force, the lack of it, and what effect would social assistance programs have on sort of the lack of the labor force?
Well, the problem is the labor force, we have a lot of unemployed. And there's no question there's a shift going on in the economy. And the shift is just as dramatic as it was the shift from an agriculture to a manufacturing economy that occurred in the early 20th century. It's an extremely important shift. This shift, of course, is from a manufacturing economy to a knowledge-driven economy, or some will call it technology-driven economy. To the extent that anybody on a short-term basis can help those that are unemployed through unemployment benefits or through $600 for a family that's unemployed, that helps short-term. That's what we need now. On a longer-term basis, Paul, we're going to need social programs like you're suggesting. Exactly what they are going to be and how they're going to be shaped, I don't know. But we need something to that effect, but primarily to help engineer this fundamental shift that's going on in the US economy to a less labor-intensive economy and a more knowledge-driven economy driven by the exponential progress in technology. I don't know if that answers any questions, but
yeah, no, I think that's good. Let me shift it a little bit. There's a question here that said you didn't seem as concerned about the increase of the national debt, and can you share your thoughts on that? So it came across like, you know, hey, don't worry about the debt. You know, it's big as ever, but we got so much other good positive stuff going on. Maybe you could expand on that.
I am concerned about it, but I can't quantify it. I know Reinhardt and Rogoff at Harvard have tried to quantify or identify what the problem of the increase in national debt is and what it's going to do to our ability to expend resources, to do federal government spending in the future if so much of the money that we ordinarily spend at the federal level is carved out for interest rates. We're getting away with murder right now. And well, I don't want to call it that, but we're getting away with murder because interest rates are low, and therefore the interest rate burden of the federal government has come down significantly, allowing for ongoing expenditures in the mandatory as well as in the discretionary parts of the federal government budgets. But that's not going to go forever, because when we get past 2021, 2022, and the Federal Reserve starts to raise interest rates, then those expenditures for debt service by the federal government are going to become meaningful, and then they're going to have to cut back on mandatory and discretionary spending. It won't be significant at first. So I think we're fine now, but you get to 2023, 24, and 25, and it's going to start to be painful. So I'm concerned about it, and I think something has to be done about it, and I think something will, because I think we'll have positive economic conditions in 2023, which will allow some cutbacks in spending and some increase in taxes, dare I say.
Okay. And I know we have a hard stop here at 9:45, so I'm just going to put a couple more in here. There was one question, maybe it goes back to some of the social policies. Would a more accommodating immigration policy have a stimulative effect on the economy?
Yes, it would. And that's one of the biggest problems that we face. I mentioned before that one of the problems the economy faces is not just the growth rate in the population, but the growth rate of the labor force. If you have a labor force that's not growing, it's going to be hard to put together positive economic growth, even if it's no real improvement in their output per man hour. And one of the problems of why we've seen such slow growth in the labor force is because our immigration policies are so foolish.
Okay. And a question here on climate change impacts. What do you see as the primary impacts economically relative to some of the climate impact stuff? And do you also see opportunities in the response? So it's sort of a climate change question.
The two highest occupations, growing occupations in terms of percentage growth: wind turbine service technicians, solar voltaic installers. That's all I need to say.
Okay. One other one, Hugh. With the job market, what do you think will happen to older individuals who lost employment due to COVID but still need income?
That's the tragedy.
Yeah.
That's the tragedy, and that's why we need stimulus. And I cannot overstate how important it is for the federal government in Washington, for the Democrats and the Republicans to get together, and they're looking hard at $968 billion. That's not enough, but at least they're looking hard at something. I'm not very optimistic based on my contacts in Washington. I'm not very optimistic that they might get it through Mitch McConnell and Pelosi, but you've still got the president's got to sign it.
Yeah.
We're going to have a problem there.
Okay. I'm just seeing if any other questions are coming in here. All right. Let me end with that. So, Hugh, let me express our appreciation on behalf of all the members of the chamber. You do a great job. We just can't thank you enough. I also want to thank Pursuit Lending and Teal Becker and Chiramonte CPAs for sponsoring today's event. Thank you, Tom and Ryan. It's very important. This has been, I think, very helpful as we go into the holidays here, and your thoughts on the economy and where we're going are good. So I want to thank everybody for their support of the chamber. Hugh, be safe, stay well, and to everyone else out there, have a good holiday season, but please wear your mask, social distance, and we'll get through this together. Thank you, everyone.